Have you ever had a situation when you enter the position after a market structure shift, you got stopped out and then a true market structure shift happened? I will show you how to avoid some of these losses. There are basically 4 types of rejection from a POI. POI stands for point of interest. It can be fair value gap, order block, breaker, anything from where price can react. First type of rejection is a low probability one. It's when the first candle comes into a POI and closes with a very small wick. It is low probability because price needs liquidity in order to move, and the previous candle high and low is a form of liquidity. So the next candle is most likely to sweep the previous one and then expand. That's why the first type of rejection is a low probability one. Here's a chart example. First candle comes into the fair value gap and closes with a very small wick. So we wait for the second candle to sweep the previous candle high and then look for an entry. So this is the high. We come into a lower time frame and we wait for a market structure shift. Here it is, and now we can enter a position. Stop loss on the highs, and we can target a 1-to-1 risk to reward. After some time it hit take profit. The second type is also a low probability one. It's when the second candle closes below the previous candle low or above the previous candle high. It is because if you want the price to go higher, the candle should show us strength. It shouldn't close below the previous candle low. In bearish case, we would want the second candle to close below the previous candle high. So if it closes above the previous candle high, it shows us that it doesn't want to go lower that much. And if it closes below the previous candle high, it shows us that it wants to go lower. Here you can see a fair value gap. The first candle closes with a very small wick. We wait for the second candle to sweep it. Here is the wick. We come into a lower time frame to look for an entry. Here is a 15-minute market structure shift. We can now enter a position. We put stop loss on the high and we target 1-to-1 or 1-to-2. I will target 1-to-1. Let's see how it plays out. And we get stopped out. But why did it happen? Because we didn't check the second 4-hour candle. As you can see, the entry happened after the second candle closed, right here. And the second candle closed above the previous candle high. So the price shows that it doesn't want to go lower. And there was also a 4-hour bullish fair value gap. It also stopped the price from going lower. Remember to always check higher time frame before entering a position. The third type of rejection is a high probability one. It's when a first candle closes with a big wick. It is because if the price wants to go higher, it is not likely to come all the way back to sweep the previous candle low and then expand. Usually it will come back into the previous candle wick and then expand. So you would want to look for an entry when the price comes back into the previous candle wick. For example, price comes back into the wick, it creates a market structure shift and you enter the position. Here is a 4-hour fair value gap. Price comes into it and the first candle leaves a big wick. So we want to look for a position in this area. Come into a lower time frame and wait for entry confirmation. Here's a 5-minute market structure shift. Now you can enter your position. Put stop loss under the low and target, for example, these equal highs. You can even target higher if you want a bigger risk reward. For example, this or this high. But remember, the higher the risk reward, the lower the win rate is. The fourth type is the highest probability one. It's when the first candle closes with a very small wick and the second candle sweeps the previous candle low to then expand. You would want to look for an entry after sweeping the low, not before. Here is a chart example. We can see a 4-hour value gap. Price comes into it. The first candle closes with a very small wick. Here is the low. Now we want to come into a lower time frame. We wait for the price to sweep the previous candle low and we can look for an entry after a market structure shift. So here's a 5-minute market structure shift. We can now enter a position. Stop loss here. And we can target a 4-hour CRT high. So right there, we'll talk about CRT in next videos. You can target even these highs, depends on the risk to reward you want to achieve. But I will stick to the CRT. As you can see, the position took a lot of time, but it finally hit take profit.